Hi guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about how much you need to diversify your portfolio when you're investing. Well, one of the most important principles of Rule 1 Investing is also one of the simplest ideas, and that is you need to invest in what you know. Warren Buffett calls that, put it in your circle of competence. And it's really crucial that you are able to understand the true value of a company. And that's really key. And you can't unless you understand the business deeply, right? I mean, that's impossible. And you got to be able to spot stuff like potential problems that will impact maybe the entire industry, the entire sector that this thing is in, because something is changing. And you want to be able to understand that this company is going to be rocking and rolling, bigger and more successful and more productive 10 years out. And if you really can't know that, I mean, a lot of companies, no one can know it. A lot of companies, somebody really smart could know it. A lot of companies, somebody in the industry can know it, right? So we got to focus on what we can know. And so, sometimes people come to me and they're really kind of concerned that their circle of competence is so small. It's like, I don't know. Now look, I get it totally. When I first started as a river guide out in the Grand Canyon, and my circle of competence was, like that big, size of it was nothing. I had a lot of confidence that I understood Harley Davidsons, motorcycles, because I had one, and then I had a lot of confidence that I understood the tourism industry because I was a guide and I could and I'd actually looked into owning a river touring company. I had some sense of it, right? So I felt comfortable even with cruise ships. So my circle of competence was extremely small, but I started right there and just started to expand out from there. And I'll tell you, that's what you do. You want to start real small. There is not any such thing as too small. You don't need to be thinking in terms of dozens of companies. In your lifetime, you can think in terms of 20 companies, right? In your lifetime, 20. So gosh, start with one. That's all you need to start with is one. I just got a note from one of our students. I love this. This is so great. Got a note from one of our students who is an expert in, he worked deeply in the industry, really complex industry for me. It's out of my circle of competence, where they make machines that make silicon computer chips. And he invested in two companies, with a significant amount of capital, invested in two companies that he really understood because he competed against both of them and knew they were both better than his company. And those things made him $2.5 million in about a year and a half. I mean, it's unbelievable what this can do for you. One of my friends here, who is also the guy that comes over and takes care of our HVAC, runs his own HVAC company. And so he understood the impact of United Technologies spinning off Carrier, which is an HVAC manufacturer. And he rocked in there with everything he had. It wasn't a ton of money. It was like $11,000, but it was everything he had into Carrier at $5. And that sucker is at $44 right now. So it doesn't take genius. This is not a game where an IQ of a 160 beats a normal person. This is a game where you focus and find one thing. So let's talk about, the kind of diversification lots of people do. Which is to put their money in mutual funds. And, I totally get it. And when we do talk about this at our workshop about how to manage mutual funds, if that's what you have, so that you're not sitting in a mutual fund when it goes down 50%, or at least try not to be. But man alive, you're buying the entire world when you go do your money in mutual funds and ETFs. And I understand why people do it, but there's no way to have breakout wealth creation by doing that level of diversification. I mean, I just looked at a kid who, I looked at it. He asked me to look at his portfolio, and it's 10 ETFs. And this is very standard. And those ETFs are long bonds, short bonds, middle bonds, international stocks, national stocks, growth stocks, big stocks, little stocks. I mean, it's just, okay. And so this is massive, you got mortgage bonds, massive diversification across thousands of stocks. And what that does is it guarantees him a sort of a mediocre rate of return if things are going well. And it's going to go down big time if everything goes down, but not as big time as it would if you're just in stocks. So it reduces the volatility. But man, there's no chance for breakout wealth. Now, it's appropriate for him because he needs this money for medical stuff. But if you're trying to break out and get generational wealth, this is just not how you do it. That's why Warren Buffett, Lee Lu, none of the investors that we follow, that we teach you from, we don't invest in mutual funds or ETFs. Okay, second, when we're talking about investing in individual stocks and companies, we're talking about doing things that you know about, sticking to your circle of competence. We've talked about here many, many, many times. But let me just tell you that is just massively critical. It's one of 4 things that you really have to know. Stick to your circle of competence. You got to do that. And you've got to make sure you get a margin of safety, which means you have to understand the business is a business and has a real value. And it's just really important that you think about it properly like that, you guys. It's just super important. And then you treat Mr. Market, instead of like some kind of a savant that's pricing everything right, as the sort of manic depressive that it is, right? I mean, right now it's manic. It's irrationally exuberant. The market costs it's got a 2.5 yield on the S&P 500 right now, which is insane. It's got a 40 PE. I mean, you get more money out of a bond right now. Okay, so now go on to the next idea, which is, let's say you know a lot about one specific industry. Don't you want to diversify out from that? And the answer is no, because you focus deeply on that one industry, which means you learn about the company you want to learn about, and then you learn about its competitors. And inevitably, it will expand your world of what you know about into the related companies to that. Let's say like you're going to do Southwest Airlines and you really dig in deep, or say Boeing, you'd immediately start finding out about Boeing because Boeing makes their airlines. And then once you find out about Boeing, you're going to find out about part manufacturers. You're going to find out about, a lot of cool stuff. So you can just keep expanding within that sort of narrow view until really you end up with the whole world. So the idea is really try to keep a lid on it, not that the problem is you don't know enough. So the key is you just keep learning more and more. You stay very focused and your circles will automatically expand. And then you've got to be sure you know where the edge is. Be sure you know what you don't know. And the only way to know that is to get really educated about what you're looking at. And every one of you can do this. It just takes a little time. You just got to just sit and read and stuff, right? I read to Melissa at night these 10Ks that are put out every year, and they tell you all about the company, and I'm her sleeping pill. I just read out loud, and within, ballpark 3 minutes, she's unconscious. So if you find you're having trouble sleeping, 10Ks, fantastic. All right. They're written by lawyers. They're fantastic. So, just realize that it's one investment at a time. You start with one good one, you build your confidence, and you go from there. Bottom line is it's really important to be selective. It's really important that you're very confident in a few investments rather than being spread across over diversification across lots of different kinds of industries. We want 20 companies. Warren says, imagine that your entire investing career across your entire lifetime of 40, 50 years of investing, you really are limited with a punch card that says you can only have 20 investments in your lifetime of 50 years of investing. 20, that's it. If you realize that you can only get 20, wouldn't you take your time and make sure that first one is really good and you didn't waste a punch? So that's a great way to think about the kind of focus you need here. And just understand that you're not getting much risk adjustment by diversification. It slows down how bad things will get when things get bad, but that's about it. And it is really, really frustrating for people who are diversified to watch their portfolios go down 50% anyway. So just stay focused. This is the best way to make money no matter what the market's doing that anybody's ever invented. It's the one way you can be sure you're going to get a real long-term high rate of return with high degree of reliability. Take time and learn this, you guys. Now, I'd love to hear from you guys. What industries are in your circle of competence? Just leave a comment below with your answer. I'll be sure to follow up with you. And thanks for watching. Now go play. Hey, you guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to diversify or not, hit the like button and please share the video with your friends. And if you want more investing content, just subscribe to my channel. We've had so much great stuff here. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.